There are a lot of different components that go into the inflation that you could potentially receive over time by staking on the network. So different things that go into this are the inflation rate, which actually changes and increases over time until a given participation rate is reached. So I'm tracking the participation rate, so the percentage of LPT that is circulating that is being actively staked. I'm tracking the inflation rate. I'm tracking the inflation that CoinFund's transcoder on the network receives day by day. So there are also a variety of inputs that go into that. So the relative amount of stake that CoinFund has staked to our transcoder, for instance, is something that would dictate the inflation rewards that we receive over time. So I'm tracking that very actively as well. And that just goes into kind of what the return profile of a strategy like that would look like.
Great, thank you. Jose, you've written a lot of good posts. This is how we met. I was impressed with a lot of your Medium posts. And I think you kind of centered on token valuations and the data behind them. But give us a background about what you look for.
So I'm Jose Macedo. I'm the head of advisory at AmaZix. We're basically a full stack advisory firm. So we help projects execute successful token sales, and then we help them afterwards as well. So we've worked with about 120 projects and helped them raise around 1.3 billion. And over time, we've built up, we're pretty big. We have around 100 employees over 4 different divisions, a bit less than that now. And so data sort of runs through the entire process, from the working with the project, so doing the due diligence, figuring out whether these people are legit, what this token could be worth, whether the token economic model makes sense, to, during the token sale, communicating that data to investors. So making sure that the token economic model is communicated properly, that there's a clear valuation framework. Like nowadays, we don't think you can launch a utility token without having a clear idea of how it'll accrue value. So, ideally not something like MV equals PQ, but rather a utility token that can be valued using something closer to a discounted cash flow or a discounted value flow if you prefer. So, if someone doesn't have a utility token that's productive, from our perspective, they're competing with sort of Bitcoin, Decred, Monero, these types for non-sovereign store of value. And that is a difficult task, and you need to have something really unique. So ideally, what we're looking at is sort of work tokens, governance tokens, different types of tokens like that, and trying to figure out what they're worth, how to communicate them. And then, of course, after the sale, we also work with projects on their transparency, their reporting, all of that stuff. So we're also trying to define and working with Messari and also getting advice from William on how to figure out proper reporting standards for these projects. So, quarterly reporting, quarterly conference calls, what metrics should these projects be reporting, what they should be being transparent on, having yearly audits, where we actually check up on everything. So that is sort of, runs through the entire process for us.
Do you look at the economics of the network itself, and based on what kind of data, if so? Like transactional or other type?
Yeah, so for us, the stage that we're in, the main thing that we're looking at is sort of projections and trying to figure out from a sort of philosophical perspective, what is it that makes this token valuable? Because what we saw in 2017 is and 2018 as well, is a load of tokens launched that actually had no way to accrue value. They were, this is my network, you need to use this token to access my network, and that's the value of the token. But obviously what we've discovered since is that that's going to be a very high velocity use case. It's going to be very hard for them to accrue value. So what we're looking at is basically tokens that have some way that they produce value flows or cash flows. So whether it's a work token like Augur that you stake in the network in order to receive some kind of value flow back, which can be valued similar to a taxi medallion, or stuff like governance tokens, which, there's some interesting work been done by Phil Bonello on valuing governance tokens, like assessing the cost of a fork. But for us, there always has to be, in the utility token model, there always has to be a reason for the token to be staked, so as in, which acts as a velocity sink, and a value flow that's generated from that.
Good.
And very few networks are actually generating any fees whatsoever. Mm-hmm. I think Bitcoin and Ethereum might be the only ones with multi-million-dollar fee markets, period. So all of the fees that are getting generated, if you look at many of these assets like resource tokens, where they give you some right to earn if you put in work, there's just no fee market to speak of. And in my eyes, much of that value is ephemeral because the quote-unquote staking yields that some of these projects are generating, really you're just kind of running in place and you're staking so that you don't get diluted. You're not actually earning anything. You're only earning at the expense of people that do not stake. At scale, when these networks are healthy, like LivePeer, you're going to earn staking rewards that are proportional to what you would otherwise be diluted down by. So I think one of the things that we look at is what's the net staking yield to the extent that you've got a proof of stake system. And if these are going to be valued based on network fees and value generated by the network itself, you need to see some type of usage and some type of bona fide fees that are not just inflation rewards.
Is there a lot of manual work involved because this is so new? So it's not just readily available.
To track that or to
track
stake?
And to set into place the right traps and the right triggers to get this data? Or
Well, I think a number of, first of all, I think that this is commoditized in relatively short order. The initial cost can be quite expensive to spin up full archival nodes and actually get a historical node spun up, especially for Ethereum and EOS and some of these blockchains that are just growing like crazy. But once you've done it once, there's really no reason that Google and Microsoft and Amazon, the big cloud storage providers, won't ultimately have full archival nodes spun up so that any data provider, any developer can very easily parse this data and manipulate it any way that they want. So I think if you're going to run a staking service or actually participate in the network like CoinFund is doing, then you're going to want your own infrastructure. But a lot of the blockchain data and markets data is commodity data where the value is ultimately going to be in creating tools and frameworks that sit on top of that help people make sense of all the underlying.
So I think I agree in the future getting this data will be somewhat commoditized, but like one caveat there is there is kind of a wide array of staker experiences that you're seeing kind of out in the world. And I'll use LivePeer as an example one more time. Doug is about to come out here and talk even more about LivePeer, I think. But so they have a LivePeer Explorer, which I've been on every day probably for the past year to check our stats. And it's actually been really interesting to see that site evolve over time. So one of the things that they've done is incorporate a project called The Graph, which, full disclosure, is a CoinFund portfolio company. And what that has the integration of this decentralized index and query protocol has done has allowed the Explorer to serve up data in a much more faster, real-time way, and also to show more sophisticated metrics than had been kind of like easily queried out before. So what kind of like some of these data layers that are currently being built out and integrated across protocols today are allowing metrics like percentage of errors or missed rewards over the past 30 days. So that's a metric that would have been very expensive and resource intensive to query out from a protocol before, but it's a key metric for any staker to understand and any delegator to understand. And I think another point that Ryan made is any developer may be able to go in and query these APIs, but I think it's very important to have very easy to use, intuitive tools that someone like me, who's not a developer, who's not an engineer, who wouldn't know how to code, like tools that pull this data back for me, to understand how and where to delegate without having to code kind of my own scripts.
I'm not an investor in the Graph, but I will also say that they're very good. So if you're interested in checking them out, I encourage you to.
Arjun, you were going to say, I see you nodding a lot, so you want to say something?
No, so I think that the, to the point earlier about...
Can you have the microphone?
Oh.
Yeah, thanks.
Potentially trying to derive any sort of understanding of valuation. I think that, blockchain data is potentially, proving to be very informative, I think, even in understanding sort of the broad cryptocurrency market cycle. I think that one of the kind of landmark pieces of work here was done by the folks at Unchained Capital a couple of years ago. The team, Drew Bunsall there, outlined what they described as the HODL wave, which is people early on in the cycle, people accumulating lots and lots of crypto, and then near, as prices extend, people actually selling that out. And what's interesting now is that, with on-chain tooling getting much better we've actually gotten to the point where there's a number of different novel metrics which are, sort of at the intersection of both price data and on-chain data. Some examples of this, Adaptive Capital, a crypto fund, they came out with a metric called MVRV. Nick Carter's done work on realized cap. And some of these different metrics, what they're trying to do is, basically identify what the patterns are of people, of speculators, essentially. And, I think that's, right now, the market might not be sophisticated at large to really process and understand this, but I think that over time, this type of research is going to prove to be very valuable.
But that's where the issue is today. I mean, there are no standards for what's important, what's not important. If you look at the web, we know more or less what data is important in websites or in e-commerce or something like that. But in the blockchain, it's still such a new field that what's going to emerge is it going to be multiple data points or one or two? What are your thoughts kind of projecting into the future?
Yeah, I think it's a good question. And it's not. I actually think it goes even beyond that. It's not even that. It's hard to tell what's important and what's not. Even in the data we do have, for example, a lot of the assumptions that some of the metrics that I described, like MVRV, make is that they assume that every time a UTXO moves, they assume that that's someone selling, right? That it's someone who's choosing to spend their Bitcoin, when there's a whole number of reasons why why someone could move. Maybe they're sweeping all of their balances into one address or something else. I think that these trying to determine the intent and the use of any given agent by just looking on chain, I think there's definitely it's both a science and an art, and I think over time one of the things that I've been thinking a lot about is as privacy and fungibility solutions improve, whether it's actually going to be even harder in the future to glean a lot of this insight.
Is transactional data really the important thing? Because there's been a bit of a debate lately where blockchains like EOS and others that are not so decentralized, they are touting very high transaction numbers versus Ethereum, who is more decentralized. Their transaction numbers are lower. So Joe Lubin introduced the distributed transaction kind of number. So it's a factor that goes on top of the actual transaction. It's more difficult, basically what he's saying. It's more difficult to have distributed transactions than to have centralized transactions. What do you think of that kind of distinction?
Yeah, it's. Selkis, did you want to jump in? I know.
Well, I'll start with a 2-second spicy take. Okay. I think network value to transaction is the most bullshit metric in the space. I think transactions per second is a close second because no one's actually using these things yet. So I think a much better proxy. I don't know exactly what Joe calls it, but I'll go back to the fee example, right? If you're going to try to use a censorship-resistant blockchain, you should be paying some fee to secure that transaction if it's actually economically valuable. Otherwise, why aren't you just using a distributed database? I think that's a valid critique. And now there are arguments to be made for things like EOS and other high throughput systems that are more platform censorship resistance versus sovereign. And Kyle Samani and others, I think on this panel even, have written about this dynamic. But generally speaking, if you think that something's valuable, if you are trying to create a secure, decentralized ledger, fees are a good thing, and I think we should probably track that within reason and figure out where the real demand is for these distributed systems.
Yeah, and on the subject of comparative metrics, I think that potentially one alternate way to think about it is to think about the aggregate value of what's being secured on chain. So one, in the case of MakerDAO, it could be the total amount of collateral that's locked up in MakerDAO CDPs that you consider. In the case of Bitcoin, it could be the amount of Bitcoin that's being held in P2SH multi-sig contracts, which, if you were to look at it that way, PDSH multisig is probably the most used smart contract in the whole space.
So to Jose's point, that applies to money, right? So a lot of those metrics apply to money. What I think is interesting is if you think about non-money tokens, and that's where Jose's written quite a bit, and I agree with him, you have to look at non-money-like metrics.
Yep.
Yeah, and I think, though, even for MakerDAO, when you think about sort of measuring the utility of ETH by the amount locked up in collateral, ETH doesn't really have doesn't really have a competitive advantage as collateral, I think whatever wins the ultimate non-sovereign store of value will be used as collateral everywhere, so I do understand the metric, and you can probably equate, there's opportunity cost to capital, so 400 million locked up in DeFi is still significant, but I don't think, and I think that sort of highlights, our discussion sort of highlights what's happening in the space is that we're still super early, right? Like, the stock market was born in the 1600s, and we had DCFs in the 20th century after Benjamin Graham wrote Security Analysis. It took like 300 years. I'm not saying it's going to take 300 years, but it's going to take a while. And right now, I think what we see with a lot of the metrics that's being picked is there's a lot of like reflexivity going on. And that's a buzzword in the space right now, but I think that's a really, like George Soros initially wrote about it in relation to traditional markets, but I think it applies even more to crypto, because when you think about like, we try and think about the world as being sort of data, like we observe the data and then we act based on that data, and those two are independent. But in reality, our perspective of the world is always incomplete and distorted. So the data that we pick out is also incomplete and distorted, and it causes an action which then affects the data and creates these feedback loops, right? And like the price isn't just sitting there passively reflecting the data, it's actually interfering with the data because obviously in traditional markets, a company that has a higher price can raise more capital. So it can sustain itself where a company that has a lower price doesn't, even beyond fundamentals. And I think you see that a lot in crypto. Like the blockchain not Bitcoin narrative emerged after the 2014 bear market, right? The Ethereum token economics sort of FUD emerged after Ethereum dropped in price. It's like these narratives follow the price action, they sort of don't precede them. And I think the same thing's happening with the data right now. And Chris Bernitzky's written well about this, about how the model, the valuation model and the data points that win will also be reflexive in that they will apply to the data, but they'll also reinforce the data as people use them more to value these things, right?
But it seems to me that we have a lot of blind spots today in the blockchain world where a transaction is not necessarily linked very clearly to what the activity is behind it. We don't know if it's a selling or a buying or if it's somebody moving money to themselves. Like, why is there so many blind spots?
That's a feature.
It's a feature. It's part of it for privacy But on the other hand, it doesn't tell you the whole picture, and we can't seem to be able to predict it too much.
I'll talk our own book just for a minute. This is one of the reasons that we started with a pretty boring but important component at Messari around disclosures, because we do think that as additional privacy features are layered onto even the largest blockchains like Bitcoin, the only way that regulators and enterprises and really individuals are going to have faith in these systems is if they don't think that the entire economy is going to devolve into a black box, which is kind of terrifying, right? So I do think that an approach that preserves privacy and fungibility, but that allows trusted parties to share things like view keys is ultimately going to be the norm in the future if this technology truly does take off, so that you can actually have some semblance of at least macro intelligence for how funds are flowing, even if individual parties have privacy.
And so I just to kind of like echo what Ryan's doing, because I love what Messari is doing so much around standardization and transparency. I think when you kind of compare crypto markets to what you see in equity markets today, there are obviously massive differences, but in equity markets for public companies, you have regular kind of like standardized disclosures that come every quarter, every year, and obviously people have gamed them from time to time, but more or less what are kind of the underlying components of all of the kind of data points, the balance sheet, kind of like income, profit, loss statements that you're looking at. We do not have that today for decentralized networks for tokens. Messari is working on them and is doing like fantastic work, but like before even figuring out, okay, what data points matter, I think understanding what makes up a given data point that we're looking at is incredibly important. I mean, without kind of like naming specific examples, there has been a lot of talk around what actually makes up a circulating supply number, which can be used to make a market cap seem overinflated based like versus what it may be in reality based on like vesting schedules and tokens locked up, et cetera. So I think, yeah.
I'm happy to name examples.
Go for it, Ryan. Or maybe not.
I think everybody knows.
We can take a pause and take one or maybe two questions, and I'll come back and I have one more question to the panelists. Let's see if there are any questions in the audience here in the middle. To your left, David. Yep.
Just a question regarding proof of stake. So as you mentioned, it motivated the people to do certain work in order not to be diluted. If everybody would do the work, essentially everybody would stay in the same situation. I'm just thinking a little bit from a tax perspective. It's pretty boring, obviously, but you're doing work, you're rewarded with additional tokens. So essentially there's not necessarily positive net value, but if the taxation on it is as is today, we even pay for it. We need to work not to get diluted, and you get taxed on it. So is that efficient?
I mean, that hasn't been defined. The IRS still hasn't given clear guidance on what my tax reporting liabilities are when I buy a cup of coffee, so I'm not holding my breath on them figuring out proof of stake anytime soon. But if you look at it like an equity, right, if you had a stock dividend, not taxed, but if in this case you're doing work to earn a dividend, it's kind of in that gray area where is this income, is this a dividend? We don't like to say dividend because these aren't stocks. It's a lot of this is a nomenclature thing, which is confusing to people in the industry and outside, especially. But I just think it's probably way too early. I personally would be terrified of a tax bill that I'd get if I was running a staking service or if I was dedicating a large chunk of my currency to a proof of stake system right now, because I just don't trust that the regulators, especially the IRS, is going to be very forgiving and visionary in terms of how these should be treated.
One more question.
Hi everyone. Thanks for the talk. Very interesting. Just one question in regards to all these ideas on how to value, what this crypto or this token is worth. With the concentration of wealth or crypto in the hands of various whales, to me, coming from a trading background, it seems that more of these prices are moved by market forces and not necessarily rational, traditional valuation. So my question is, how long does it take, and will we even get to a point to where these tools are useful? Thank you.
I think that's a great question, and I would definitely agree that if you look at it, to Ryan's point that he made earlier, a lot of these resource networks, for instance, are not even kind of generating fees right now because they're still in the process of bootstrapping the supply side that they need to provide those services and be paid fees for their work. I wouldn't be able to put a time on when you would be able to kind of put into place more rational, traditional kind of DCF or DVF, I guess, models to value these things. But I think when these networks start to go live and deploy services in exchange for fees, you may see more kind of ration and logic come into play in terms of valuation. But I still think there would be a fair amount of speculation, to be honest.
Yeah, I mean, I definitely agree. I think there's some people doing some interesting work on trying to measure that very kind of activity, right? Like the Adaptive Capital guys, the Delphi Digital guys came up with their UTXO and the hodling waves that was mentioned before. But I think the idea is if we come up with a fundamental valuation framework, so not NVT, not these relative valuation frameworks, but a fundamental one, then you could technically be sort of a value investor in the space, right? Like Warren Buffett, Seth Klarman style, buy it when it's trading under its intrinsic value, which would be defined as, the net present value of whatever the cash flows are that go into supply side, as in the case of a work token. And you just buy when it goes under that and sell when it goes too far above that. So hopefully if we develop these models, then we can start to have more rational arbitrage mechanisms executed by value investors in the space.
And last thing, it's a lot of the signals that people are working on right now, a lot of these indicators, they're like very useful building blocks. I think a lot of the valuation frameworks, like the ones that were mentioned earlier, I think that, you know, they're almost like a grand unified theory. You know, they're attempting to, you know, solve a much bigger problem. So they seem incomplete right now, and they may never be totally indicative. But a lot of the work that people are doing on some more niche metrics and like the UTXO analysis he mentioned from Delphi, like I think that those are really, at least directionally, very interesting and much more kind of grounded in today's market environment.
Great. I want to ask you all very short, very quick question with one short answer. What is your favorite metric, blockchain metric, that either exists or doesn't exist that you want to see? Just like very short answer.
Realized value to market value.
Realized
Basically-
value and
Basically, the price at each mined block on a cumulative basis, the 2 times that's fallen below 1, January 2015, December 2018.
Tier, okay. All right, do you have
Ryan took mine, but I'll go with block BDD. So
which
block
is, can you explain that?
Yes.
Days destroyed for UTXOs.
Correct.
I'm putting my venture investor cap on, and I'm going to say users. I want to know how many people are actually using your network.
Yeah, so I think for currencies, probably some measure of fees, because as Ryan mentioned, there's no way to really game that. For other tokens, probably NVT signal weighted by sort of UTXO, which is the most recent one that Delphi has been working on. I think it's really cool, so check it out.
Thank you very much. Let's go to the next panel.
Thank you.